Hello, YouTube. We've been focusing on this pattern of the red arrows, but today we're going to focus on the yellow box, which is where I believe the bears are wrong. Greed is back, and the net shorts appear like they are on track to go net long, which is usually a pretty bullish signal. We had unemployment rate coming in 10% higher than anticipated at about 3.8%, and that's pretty notable. So if we look at the chart one more time to try to understand what we're talking about here, we're talking about this weekly pattern right here, which now, if we delete everything, it's pretty simple. 3 down weeks, 1 up week, and then reversal. 3 down weeks, 1 up week, and then reversal. And that's pretty simple. It's simple because we print a higher high, we print a higher high, we printed a higher high. But then by the end of the week, it's a bearish engulfing where we close below. So it looks like the bears are wrong this time because this time it did not happen. It looks the same as every previous dip so far this year, but it looks like all that we needed was actually just a little bit of a paper cut, and that maybe we're going to be able to avoid the worst of the drop so far this year. And the reason why I say that too is because now we're back into greed, and the reason why this is important is because we've been talking about this stat for the last little bit, but if we look here, after the S&P rallies 20%, which we've done, we have to think about what normally happens on the drawdown, the pullback, the correction, the crash. Sometimes is what we call it in the videos. It's only 15% of the time that 5% is enough. But technically speaking, when we look here to our pattern, it's been broken. So if we look to our monthly chart, which is the other one I think has a very high potential to fulfill, so far we're on number 4, where we currently are consolidating. So let's make it really simple. We have 3 candles right here. We have 1 green and 2 red. What do we have over here? 1 green and 2 red. We have a hammer, which means that we close above the previous candle low for the first red candle. That happened here as well. As long as we hold the low or print a higher low, that means we're going to hold a pattern. So if we have an inside bar on the monthly, I would say that so far it is tracking. It's not going to take very much for us to go higher. It's about 4,600 or 460 on SPY. And we have about a 4% buffer for us to go lower before we test that low of the month. So what I'm really going to be watching for is whether or not we have a fade, if we actually do come back down, and whether or not it holds. If it does, great. If we ultimately go higher and break it, that's a different pattern too. Maybe we're not going to repeat this pattern here. Maybe 4 out of 5 of the recipe is good enough, where it's the 80-20 rule. Let's see what happens. So there's a lot for us to digest and go through as we go into this end of the week. I'm going to ask you for a huge favor as we go further, though. I'm going to ask you to please consider smashing the thumbs up and subscribing to the channel. If you haven't already, I would greatly appreciate your support, and I'm going to thank you very much ahead of time. Thank you so much. All right, so we do have a stream today, so we're not going to go through. Let me just get rid of that thing there. There we go. So we are going to have a stream at the end of day today. So we're going to go through and start wrapping up to try to make sure that we get the stuff out of the way you need to know today, but leave room for the stream as well. So the drawdown could be small, it could be big. We note that the shorts could be going long. We'll get another data print today at 4:30 or 30 minutes after the market closes. What drove the market today is that the unemployment rate went to 3.8, which is the first time we've actually seen this number tick up, which is very notable because this is the part where maybe now finally the Fed has done enough where they can actually put their foot on the brake. And we note here that for the first time, we're going to 3.8. We haven't seen a reading that high going all the way back to 2022. And this matters because we've been talking about whether or not we're currently at 2007 or at 2008. So if the unemployment rate is just starting to go up, I think that could be a signal. If we get closer to 4, the Fed could be on track to pause like we did here for 1 year from July of 2006 to July of 2007. We did nothing on the Fed funds rate. That would mean that the delayed effects, right? The lagging effects, blah, 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 all those things, right? The lagged effects of monetary policy. I think that we could still get a bad month in September. We talked about this yesterday. We'll briefly go through that now. 4%. That's what we could be looking for if we're going to be going down. We talked about that just now. And the decline for 2020 and 2021 is around 4%. So that could be the crash of 2023 repeat, or maybe it couldn't. Here are the bulls. So why I think this could be bullish and why the bears might be wrong is because like people like Morgan Stanley are looking over here and saying the market could rally to 11 more percent, basically going to new all-time highs. Tom Lee, 4 reasons why we could see 2 to 3% in September. Not that these guys are always right, but Normally, what we do, there's different ways of looking at the data. So this right here says worst month in 30 years. Usually, the seasonality chart says, well, we kind of just close like where we open. We open right here. Let's look nice and close. A little bit of an up move to start the month off, but we actually don't close that much lower, and we close higher than the low we established in the month. So if we go here to our daily chart, have a look here at SPY. That's pretty much right here where we broke out. So that breakout is at about 435 to 440. So as long as that 435 to 440 area holds, that's pretty bullish. It's very bullish because on the weekly chart here, it means 5% dip was enough. We bounced off exactly the first area of support we would expect it to, roughly 432 or our August high. And the bulls look like they could be going for 11% by the end of the year, 2 to 3% in September. Seasonality chart could play out where we go up, maybe on Apple, maybe on the Fed, come back down on the Fed, and then boom, towns, right? Santa Claus rally, let's go. So if you enjoyed that, please come hang out with us for the final hour for the market. We're going to talk about what we can do with the September data to see if we can get prepared. And if not, the weekend deep dive is now queued up here on the left-hand side. Thank you so much for tuning in. I look forward to seeing you at the end of the day or for our weekend upload tomorrow. Thank you again.